We're going to look at the stock market now, the short-term view, and we're going to look at XLF and make a little comparison in there. The reason I want to do that is because, well, I spoke earlier in the show, and if you're only watching this clip right now on YouTube, you should go back and watch the whole show. The interest rate structure with a flattening yield curve happens when the Fed tightens, or when the Fed is getting ready to tighten, the market moves ahead of that. So when banks loan out money, when the yield curve flattens, their margins get squeezed because they pay more for the money that they loan out, and they get less for it because the longer term rates are not keeping up with the shorter term rates. Or in this case, in this last week, we saw a rare circumstance where the 30-year bonds fell 9 basis points in yield, while the 10-year notes gained 4 basis points in yield. And that is what happens in a time period when the Fed is getting ready to tighten, or is in a tightening phase. Eventually, they invert the yield curves. And we saw some inverted yield curves in the last couple of years that was just on market conditions, really not on the Fed doing very much. And the markets don't like when that happens. So we're a long way from the Fed inverting the yield curve out there. But the markets are acting like they're, smelling it coming. And the financials have a very good message for us right now that I think is important to look at. I want to look at the S&P 500 first. So I'm going to jump off of soybeans right here and put up a special chart that I have here in SPX. The reason it's a special chart is because let me just get this blown in right over here, because I'm highlighting, I don't have all of our normal information on here because I'm highlighting a repeating 15-day rhythm in the market right over here. So I'm just going to look right in here, and you could see this 15-day cycle very clearly. So the low made right over here was 15 days off of this low. And this dashed line illustrates the ideal or average that is a 15-day cycle. So you could see this was actually a 16-day cycle right in here, because the total from here to here was 31. So this was 16. This was 16 right in here. And this odd shape right over here that made a diamond. Diamonds are often consolidation patterns, and it broke out on the upside. Distance from here to here, 15. You can see, let me follow this. 15, 16, 16, 15. You could see right there. And now we're in day 11 right over here. So what that says is that this breakdown that you have right over here, and we've had strong momentum, and it is about to go neutral. It's about to turn blue. That momentum is getting lost in here, and we're about to break that support right there. You see how close we're getting, and just getting close is bad news. So what that says is that this should fall, if this is day 11, let's just say 3, 4, 5, 6 days, somewhere right in here. Still, that doesn't speak very well to the market being able to rebound right now. And then this yellow zone is the correction of the bigger cycle. And you can see right in here and right in here. And that's what we've been talking about, was the fact that the market would be pulling back in here. And I've been showing the intermediate weekly charts, but I wanted to show the daily because I want to compare it to the XLF so you can see. So what are we looking for the next, 1 to 3 weeks? Well, it's further decline. The supports that you can see right in here are around 41.50. We talked about 41.50 the last couple weeks. And down over here around 41.30. Those are reasonable targets to get in this into the midweek next week. So we'd be looking for it to decline into somewhere around Wednesday, Thursday of next week. Tuesday might be a little early, and so Wednesday, Thursday of next week. And then turning up, and then this is the proof of life period. If the market does what we expect, break below this low, give you a negative shape cycle, then the odds are very high it will fail before making a new high in the next rally. that will, if we still have a bull market right now, or a bullish market, it would be able to rally and take that out. I think it's a very low probability. I think it's going to try to rally here end of next week into the following week after that. It will not make a higher high and then move down pretty significantly. So that this target right over here, that comes off of some intermediate supports. That's at about 40.60. This one right over here, 40.40. The bottom of that support zone under 4,000. Right over there. Those are all possibilities out over here for the stock market in this corrective period that we're looking for that goes out into August, late July, early August. So this, we believe, is the beginning of the stair-step downward move, and this proof of life will actually be proof of death, and that the market will prove its peak and then be moving down. Now, I want to show you a comparison in here that I think is very significant, and this is a very good lesson on this style of analysis. Let's look at XLF on the daily chart. So we're going to look right in here as this uptrend was established. And what I want to show you in here is are the cycle rhythms. So this is the cycle bracket that you can see right in here. I'm going to highlight that cycle bracket so you can see how many days are in each of these cycles. Come on. It's supposed to highlight and show you. There you go. So this is a 31 bar cycle. So it's 31 days. A lot of people that are cycle analysts use the nominal numbers, the 5, 10, 20, 40, 80. We do not because we believe every symbol has its own cycle rhythm. And you can see the rhythm is very clear in here at averaging around 31 days. You can also see that this decline right over here is coming into this bottoming time frame, which means that you're probably going to get a bounce coming in XLF. But here's the key lesson. If you take these ideal cycles right over here, see them moving sideways, and if there were no forces pushing it up or down, it would just move sideways. You'd get it moving up, you'd get it moving down. You get it moving up halfway and get it moving down. But when you have an upward directional component, as illustrated in all of these positive signals. You see the slim ribbon PO? These are all positive signals for momentum right in here. Positive signals. The corrections only went neutral, a little bit of negative right there, and then positive, 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 neutral, and then a little bit of negative that you see right over here. Each of these cycles gave you higher highs, climbing up this upward channel. The directional component, and you can see in here the 89-day moving average, showing you how it pushes upward. These green arrows show you the upward configured cycles, all of them positive. Some of them so strong that they got swamped by this upward movement that you couldn't get any significant corrections. All the way back here, this is into November, into October of last year. So this is a long upward powerful move right there until it changed. So the directional component that we're looking at in here that pushed it up has gone from positive, that you can see there, to negative, that you can see right over here. The upward channel has changed. And how do I know that? Well, this cycle low right over here where that came, it broke down below that level. The only way that could happen would be if the upward force was leaving. And that means that we're now entering into a period of a downward force. And that would give you a rebound that comes somewhere off of here, and then a rally that fails in the resistance zone, which I'll put in there once I have the anchor point. Whoops, sorry. And then the likelihood of this turning down for the next decline right there. That's, by the way, how Head and Shoulders forms, by the patterns in the cyclical charts. And now this proves that something very significant has changed. It breaks through all of these supports that you can see there, breaks through that cycle low support right there, tells us the upward component has become negative and it's now a downward component, and the financials are about to become market leaders on the downside. That means that the proof of life period that we talked about That's not what I want. That the proof of life period that I talked about in the SPX right over here is likely to fail, and that the market is likely to move down. So in comparison, you can see that this is about to give you a little bit of breakdown, just like the XLF, and that the next rally is likely to fail, just as the XLF is indicating. That is, I think, a great lesson about how the key leadership can affect the markets. And with XLF turning negative, the financial stocks, the bank stocks, that is telling you that there is trouble out there. And again, we are saying that we think that the first wave of this significant correction in the market will take us into late July or early August on an intermediate basis. So this is the short-term view, which again, we reiterate, down sometime likely into middle of next week, an attempted rally, and then likely down again. And we'll be putting in the resistance zone once we have the anchor point for this low right in there. That gives you a very good idea as to how we do our analysis and why the stock market is very likely in a significant corrective period, if not the end of the overall bull.